we've got the rand still under pressure today, and it seems that it's a risk that actually coming off the table while we've got the dollar managing to hold steady.
I think that at the moment the market's very, very cautious around foreign exchange trading. I mean, if you look across the board, the Eurozone under extreme amounts of pressure. Obviously, there's a lot of uncertainty around the results of these stress tests that are going to be announced today. The market seems to feel as though there will possibly be about 10 failures. Reuters poll talked about 10 to 15, and they seem quite comfortable with that. But anything over and above that, I think potentially could drive the euro slightly lower. But then on the backside of that, you've got the US dollar, which is under extreme amounts of pressure as this debt ceiling scenario is not playing out well. There's a lot of political noise around it. It's driving sentiment, and obviously that's driving the likes of the S&P and Moody's to, have a downgrade watch in terms of their rating on the US, and that unfortunately is driving sentiment there. So you've got the two sides of the equation that are not really printing a pretty picture at all, and in fact, if anything, emerging markets are really on the back foot with regards to that. So you're looking at gold price continuing to do well. I think yesterday when Bernanke made his statement saying that right now they don't need QE3, but he does want the option to be available should they need to participate in something like that. And that's kept the gold slightly weaker than it was previously, but nonetheless still rallying towards that 1,600 Rand handle.
Where the ratings agencies have come under extreme scrutiny of late, just how much attention are you paying in that regard? Because a downgrade would certainly be a major event. Should significant interest be paid or attention be paid towards what's coming through in terms of rhetoric from these agencies?
Well, definitely, because what it ultimately means is that the debt becomes more expensive in the US. So it's almost a self-fulfilling prophecy, because ultimately what happens is rates blow out. At the moment, the US assets are supported because a lot of investors have to hold a percentage of their portfolio in US treasuries because of the fact that they've always been viewed as a risk-free asset. That's starting to change, and I think as ratings agencies are looking at the risk rating of the United States as a sovereign, more and more people are questioning the allocations of their portfolios, and that's really where the risk and the contagion lies in the system. I think for now, though, they really are one of the bigger economies that can absorb that kind of debt. So for now, it will remain, slightly favourable. But more importantly, I think the reason that this has come into the fore is because they've never ever really been in a scenario where they've been questioned specifically around their sovereign rating and their potential to be able to repay debt.
Yeah, well, over in Europe, we've got Italy standing out as a beacon of light, if we can call it that, or use that phrase. I mean, Italy's Senate having passed the austerity bill, and the commentary has been that we should well see the lower house and presidential approval follow today. What have you made of the swift progress that we've been able to see over on that end?
Well, I think that that's exactly it, and you hit the nail on the head. Swift progress, and that's the way to contain market contagion, because as we saw with Greece, the longer that the situation persists and the more uncertainty in the system, all that ends up happening is that the market punishes that economy, and all that happens is that the CDS spreads blow out and the cost of funding becomes a lot more expensive for the entity, which ultimately can't really afford it. So, in terms of Italy, yes, they had to issue bonds this week, yes, they issued them at all-time highs, but relatively speaking, had they let it continue, the fallout could have been much more severe. So I think they certainly did get on the bandwagon as quick as possible. They've done the right thing. They've put these austerity packages in place. They're getting approval from their parliaments. They should be able to meet the deficit levels that they need to meet within the next 2 years, which seems to create a lot more calm in the market. I think the big concern right now is, have we got 2 years in the Eurozone to weather these kinds of storms, or is there going to be bigger fallout? And I think that's where the market's really starting to concern itself, because between the US and the Eurozone, those are the biggest markets with regards to keeping the fueling alive from the likes of the East and the other emerging markets, with regards to trade flow, imports and exports.
So, Brigid, amidst all of that then, how do you even begin to start digesting some of the local events that are persisting? We've got strike action underway, of course, a fuel supply drying up, and that's set to filter through to the broader economy in some way or another, and that on the back of data that hasn't been encouraging on the manufacturing side, or like we saw yesterday on the mining production front either.
Look, I think that there's two things. We've got MPC next week, and obviously at the moment, the market remains, specifically South African economy remains relatively fragile because we really do have impact from what's happening globally. And then on top of that, we've got local issues, like you've mentioned right now, and that unfortunately poses quite a lot of significant risk in the minds of foreign investors, because ultimately risk is something that is viewed very negatively, and specifically when you've got an array of emerging markets to choose from who also have high yielding currencies. You've got to have an underlying economic picture that offers value. If you've got these kind of scenarios that present themselves where you're not likely to see foreign investment in terms of mergers and acquisitions or long-term investments because of the uncertainty around the Employment Act or the unions, these kind of nationalisation talks, etc., it creates a negative sentiment for foreign investors, and I think that's where the caution needs to be adhered to. But more importantly, I think from a market perspective, we have MPC next week. We are expecting to see the rates remain flat. It'll be interesting to see whether or not Ms. Marcus is a little bit more dovish in her statement, or whether they're still concerned and see such severe headwinds in terms of inflation. Obviously, the rand remains one of the major risk factors to watch, and as such, the rand's remained relatively range bound in these markets. We've traded 670 to sort of 695, and that's been well contained within, if you look at how the other, bigger economies have traded. Yeah. So from that perspective, rands remained relatively range bound, and it's likely to do so for the, sort of next 3 months, next 6 months at least.